If you build it, will they come? That's what regulators in Asia are finding out. As the world accelerates into the digital economy, we're going to help you stay ahead with the latest in Web3, crypto, and data. Welcome to Forkast IQ. I'm Forkast's editor-in-chief, Angie. Well, let's kick off with Hong Kong, which is trying to establish itself as a Web3 hub. But it seems not everyone is convinced this is the way to go. The Wall Street Journal, citing anonymous sources, reported that at least 2 global banks operating in China's special administrative region of Hong Kong have ruled out any activity directly linked to crypto trading, while many others remain hesitant to open accounts for customers of crypto exchanges. Now, the report also said the bank's reluctance to service crypto-related companies can be attributed to the money laundering risks in cryptocurrencies, as well as a lack of risk management frameworks in the crypto industry. The tools aren't there yet. A lack of maturity of the space remains an issue. But you got to start somewhere. Hong Kong kicked off its new licensing regime for virtual asset service providers, aka crypto exchanges, last month, creating a regulatory rail. Now, the city's rules require a crypto exchange to establish one or more segregated accounts with a financial institution, which, when combined with Hong Kong's banks' cautious attitudes towards crypto firms, creates a chicken and egg problem for digital assets firms looking to expand in the city. In June, the Hong Kong Monetary Authority, or HKMA, the city's de facto central bank, reportedly pressed major lenders, including HSBC, Standard Chartered, and Bank of China, to service local crypto exchanges. Meanwhile, some local banks such as Zabank and the Hong Kong branch of China's Bank of Communications have started servicing crypto firms earlier this year. Bandwagon still being built here, and not everyone is jumping on just yet. All right, from banks to crypto lenders, a bankrupt one at that. Celsius has started liquidating various altcoins it holds to pay out creditors in BTC or ETH as mandated by a U.S. bankruptcy court in late June. That, according to on-chain data tracker Look On-Chain. Last week, the firm pulled more than $60 million in altcoin tokens from its cold storage with Fireblocks and sent it to crypto exchanges FalconX and OKX. Now, Celsius held more than $160 million worth of altcoins on EVM chain prior to these liquidations. Also last week, Celsius founder and CEO Alex Mashinsky pleaded not guilty after being arrested in the U.S. for 7 criminal charges, including securities fraud, commodities fraud, and wire fraud. Separately, the Securities and Exchange Commission and the Commodity Futures Trading Commission, the SEC and the CFTC, also sued Mashinsky and Celsius, accusing them of scheming to defraud investors out of billions. All right, in other news, ARK Invest CEO Cathie Wood, called a star stock picker by some, is optimistic about crypto exchange Coinbase after Ripple's partial win against SEC last week. In a Bloomberg interview, Wood said the ruling is very positive for Coinbase and other crypto exchanges. Last month, the U.S. Securities and Exchange Commission sued Coinbase for alleged unregistered offer and sale of securities, along with a number of other charges. Meanwhile, Wood's statement came days after ARK Invest sold off almost $90 million worth of Coinbase stock. But Wood attributed the selling activity to simple profit-taking. According to ARK Invest's latest regulatory filing, Coinbase was the second largest holding for the investment firm. Now, last week's court ruling in the U.S. in the case between Ripple Labs and the Securities and Exchange Commission was seen as a partial win for both parties. Forkast's Jenny Ortiz takes a closer look at how will this impact the industry, as well as the other exchanges facing a legal tussle with the SEC.
The 3-year court battle between Ripple Labs and the U.S. Securities and Exchange Commission took a major turn on July 13th. When U.S. District Judge Analisa Torres ruled that Ripple Labs' programmatic sales of XRP cryptocurrency to retail traders did not qualify as financial securities or the offer and sale of investment contracts. The verdict, however, came with a critical caveat that may keep Ripple and its top brass on their toes. According to the court document, Ripple's institutional sales of XRP violated securities regulations. The court added that it would release an order to establish the trial date and related pre-trial schedules at the appropriate time. This means the case continues for Ripple and the SEC. Ripple CEO Brad Garlinghouse is treating the ruling a big win for the company. He tweeted, "We said in December 2020 that we were on the right side of the law, and we will be on the right side of history." Reacting to the ruling, SEC Chairman Gary Gensler said they will review the decision.
We were pleased from that decision, recognizing the importance of protecting investors on the institutional investors in that, and that the court movement with regard to fair notice. And while disappointed on what they said about retail investors, we're still looking at it and assessing that opinion.
The price of XRP soared about 85% to 87 cents after the decision was announced, although it has since come down to 83 cents Thursday morning in Hong Kong. U.S. Republican Congressman and House Majority Whip Tom Emmer also welcomed the court decision. In a tweet, Emmer said he intends to push regulatory clarity further with his bill, the Securities Clarity Act. Meanwhile, Townsend Lansing of European digital investment group CoinShares said the court's conclusion of classifying XRP's direct institutional sales as securities marks a considerable victory for the SEC and sets a precedent for the agency's future legal actions against other crypto. In a statement to Forkast, Lansing said, "It is important to note that institutional investors who purchase directly from Ripple may find themselves subject to a class action litigation as potential underwriters." He added this is an area to watch closely, especially if big-name venture capitalists were involved. Meanwhile, Lachlan Feeney of Australia-based Labris said the case highlighted the absurdity of the regulatory clarity seen in the largest economy of the world. Feeney said it has never been more evident that we need pragmatic regulatory clarity based on collaborative discussion between industry and policymakers. While the ruling is considered by many as a partial win, the odds seem to be in Ripple's favor. In an interview, Ripple's general counsel Stu Alderotti said banks would now want to use XRP for cross-border payments settlement. Leading crypto exchanges like Coinbase and Kraken also said they will release the XRP token in light of the recent judgment. Another question making rounds in the crypto space is this: does the verdict mean Coinbase and others accused of listing potential securities may now be in the clear? Just last month, the SEC launched a crypto crackdown unlike any seen before. The agency cracked the whip on major crypto exchanges such as Binance and Coinbase with back-to-back enforcement actions. Jason Gottlieb, partner of New York-based law firm Morrison Cohen, told Forkast, the SEC and exchanges will try to use the XRP decision in their favor.
The most immediate impacts may be in the cases that the SEC filed against Coinbase and Binance. Remember, we also have two other SEC cases against exchanges, against Bittrex in the Western District of Washington, and against a smaller exchange called Biaxi. In all of these cases, the SEC is alleging that the defendant acted as an unregistered exchange, an unregistered broker-dealer, an unregistered clearing agent, and is saying that the reason for those allegations is because they are allowing the trading of what they call crypto asset securities.
Gottlieb said that there's still a long way to go before we see the end of the case, as the SEC can appeal the decision and Ripple can do the same depending on the outcome of the final verdict. Nonetheless, he said there's a clear winner this time.
I think the clear winner is the community of people who want to be buying and selling crypto in secondary markets. Given how onerous the SEC has been in its interpretation of its own regulations, this is good news for the crypto community.
Jenny Ortiz, Forkast.
All right, time for a quick break, but we will chat with Standard Chartered's Geoff Kendrick about Bitcoin and more when we come back.
Forkast.News is your gateway to all things blockchain, breaking down and breaking through the noise with the people who know it best and why it matters. We go to where the action is, from Asia to the world. Forkast is the most reliable source of intellectual discourse and insight that informs, educates, and bridges the gap between the blockchain industry and the mainstream. The future is being built, and Forkast has it covered. This is Forkast.News.
All right, welcome back to Forkast IQ. I'm Forkast Editor-in-Chief, Angie Lau. All right, Bitcoin mining has had its share of ups and downs in equal measure over the years, with predictions of Bitcoin prices hitting a $120,000 US dollar mark by next year. Well, Forkast's Maha Shah takes a deeper look into the industry, which holds the key to the world's leading cryptocurrency.
Bitcoin, the largest cryptocurrency in the world, isn't issued by a central bank. Instead, it's created or mined by people. A bit of background first. Bitcoins are created when people called miners run a computer program to solve complex math problems. The number of Bitcoins are finite. The currency's pseudonymous creator, Satoshi Nakamoto, designed it such that only 21 million Bitcoins can ever be mined. Bitcoin mining difficulty, or hash rate, an indicator of computing power needed for mining Bitcoin blocks, changes roughly every 2 weeks. It's currently at new all-time highs.
Gaining access to that power is becoming harder and harder, and it's a good thing because it obviously is a good barrier to entry, and it restricts the power to only those that can afford to use it and that are competent in their ability to use it.
But all this mining computation in turn means the need for power. At the moment, most Bitcoin mining occurs in the United States, and this has to do with energy prices worldwide.
The US is very fortunate in the fact that it produces a lot of low-cost energy, and the access to that energy is relatively easy and simple, depending on the jurisdiction.
Some countries aren't great for mining, and that's because the energy is inherently expensive or the tax structure is cumbersome. According to Standard Chartered's recent report, Bitcoin prices may rise to $50,000 by the end of this year and skyrocket to $120,000 in 2024. So what's driving up prices?
Ultimately, what sets the price for Bitcoin is the miners and their profitability. Anything else that comes on top is all speculation. It's the miners that need to turn the machines on, that need to mine Bitcoin.
Higher miner profitability per Bitcoin means miners can sell fewer BTCs while maintaining margins, impacting the overall supply of Bitcoin. There's also institutional interest fueling demand, with a slew of TradFi giants including BlackRock filing for spot Bitcoin ETFs.
With mining being a slower moving beast, the institutions that are moving into that space understand that, and they understand that they need to put the correct policies and procedures and planning in place in order to see out this halving cycle.
So what is Bitcoin halving, and why does it matter? An inbuilt feature of the Bitcoin network that cuts miners' rewards by half happens every 4 years.
What we have seen historically is that 3 to 6 months after the halving cycle, that the Bitcoin price does eventually catch up, and then typically and technically it should double in its price or its value, so that the miners can retain that margin.
While Bitcoin halving has a positive effect on prices, it poses a challenge for miners. According to a report by JP Morgan, the next event, expected to occur in April 2024, could be a stress test for miners. It will be survival of the fittest when production costs rise and profits shrink. Only miners with lower electricity costs will find it easier to survive. But high energy consumption doesn't affect the miners only, it also comes at a cost to the environment. According to a report by climate and economic researchers, Bitcoin mining may be responsible for 65.4 megatons of carbon dioxide per year, which is comparable to emissions from Greece. Can Bitcoin mining turned green, environmental groups and researchers remain skeptical. Maha Shah, Forkast.
Is crypto winter truly over? Is it thawing? Where are we? Well, actually, Geoff, Kendrick sure thinks so. It's over. One of Standard Chartered's top FX analysts, who also heads crypto research for the bank, predicts the Bitcoin prices could reach $50,000 within this year and potentially skyrocket to six-digit levels by next year. We're going to find out what led him to his earlier estimate on the OG of the crypto world. We're talking about Bitcoin, of course, and what lies ahead. Geoff, thanks for being here with us today.
Thank you, and thanks for having me as well.
All right, I want to ask you about this latest report of yours released last week. It really perked up crypto markets after you said that Bitcoin can go up to $50,000 by the end of this year. What is the biggest driver behind this price prediction?
A few months ago, we had those US banking issues that started particularly on the West Coast. You had a couple of bank failures, etc. And that helped re-engage investors with the core use case to Bitcoin. There's this strong need, if you like, for a decentralized, trustless, digital store of wealth. And that's Bitcoin's core use case compared to other financial products and also within the digital asset space. Bitcoin, in terms of its dominance of the crypto market, has increased already. There's some other key drivers as well that I think could become very important. When we got to about $17,000 in Bitcoin 6 months or so ago, before Christmas last year, it was somewhat concerning that Bitcoin miners might sell everything. So not only what they mine every day, which is 900 new Bitcoins a day, but also what they've been holding in terms of stockpiles. So now that we're at 30,000, miners are now back in profit again. And I would say going forward, if my prediction is right and that we can get to about 50,000 by the end of this year, that probably means that Bitcoin miners will only be selling about 20 to 30% of what they would be mining. And that's because they'll have excess cash generated at those higher prices of Bitcoin. It adds up to roughly 250,000 Bitcoins that miners wouldn't be selling.
So Bitcoin halving, an inbuilt feature of the Bitcoin network, as we know, that cuts miners' rewards by half for verifying transactions every 4 years. It's scheduled for April next year. What impact do you think it's going to have on the industry?
In terms of US listed, NASDAQ listed companies, and they only started mining Bitcoin about 6 months ago. So they have very low electricity costs. They have the most up-to-date ASIC computers, etc. So what tends to happen is you see some lower cost producers come in. We've seen that already. And when we get closer to, or as we go through the halving next year, the higher cost producers will probably struggle to be profitable. And so you see consolidation in the industry. So yes, for higher costs, let's say those with higher electricity costs or those using some older machines, they'll probably exit the industry. And afterwards, that will mean the overall hash rate, which is the amount of computer power on the network, will fall. And so actually for those that remain after the halving, it increases their profitability.
You know, your report also upped the initial price estimate on Bitcoin by 20% for 2024 next year. You now predict Bitcoin could be worth as much as $120,000 by next year. Why do you think so?
I didn't go quite as deep into the miner profitability question as I did last week. And as it turns out, actually, that's potentially an even larger topside driver than I previously estimated. So I think that 250,000 less Bitcoins sold each year is a massive driver. So right now, the year-on-year inflation in Bitcoin in gross terms is 1.7%. If you just say instead of selling 900 a day, you're going to sell 20 to 30% of that, that means mathematically the net inflation falls to about 0.4%, which is very low. And so I think that in terms of demand supply drivers is more important than before. And so hence I suggested there could be some top side to that 100,000, perhaps 120,000 now next year.
Got it, Geoff. Thank you so much, and I really appreciate you joining us, and thanks for your insights, and we absolutely look forward to your next industry report. Thanks a lot. All right, time for a quick break, everyone, but we will check on the NFT markets when we come back.
Forkast News is your gateway to all things blockchain. breaking down and breaking through the noise with the people who know it best and why it matters. The future is being built, and Forkast has it covered. This is Forkast.News.
All right, welcome back to Forkast IQ. All right, where is the money flowing to? A recent report from data provider Crunchbase shows that venture funding in Web3 startups dropped 76% in the second quarter of this year. Ouch. Despite the slowdown, metaverse infrastructure firm Futureverse announced on Tuesday that it raised $54 million from investors, which included Ripple. So what else is brewing in the world of Web3 and NFTs this week? Well, Forkast Lab's very own Yehudah Petscher joins in to talk about all of that and more. Yehudah, great to see you again. What do you got for us?
Well, it's great to be here with you again. Let me sum up this week by just saying we saw a lot of fun, we saw a lot of hype, we saw very little action. The NFT market's looking rather flat, and the Forkast 500 NFT index reflects that continued downtrend that we've been watching most of this year. With the exception of January, this market almost consistently slants right. And really, this is that same trend the market has been showing us since the peak of NFTs last January. The Solana and Cardano composites reflect some larger movements, though. Both had their platform tokens, along with Polygon's Matic, named as securities earlier this summer by the SEC. And all three saw a bounce in their token price following a judge's ruling that XRP is not a security. Solana and Cardano's composite reflects that increase in their token's price, and both gained around 5% this week. Polygon, on the other hand, it didn't receive quite the same bounce, and that same optimistic news about Ripple in the past would have sent the NFT market soaring. Those days, though, they're long gone, and a majority of the liquidity that was in NFTs has left with it. So is that money parked on the sidelines, or has that been pulled out of crypto entirely? Well, it's hard to tell exactly, but data does show that the number of unique wallets holding 1 Ether or more has been flat this year, almost stuck at 1.7 million unique wallets. And that's after years of climbing steadily. It's maybe an indicator of stalled adoption for Ethereum, but it also probably indicates that traders have put their funds in stablecoins. And in fact, that is what we see happening here, with wallets holding Tether or USDC growing throughout this year. Where traders are not putting their money, however, is in NFTs. This past Sunday, the global NFT market saw its lowest number of total transactions that we've seen yet this year, but it's Ethereum that's even more noteworthy when on Sunday, the blockchain saw its lowest daily total transactions in nearly 2 years. Now, that was a time when the world was just beginning to hear this term NFTs used in the mainstream, so very interesting, really noteworthy to see NFTs fall all the way down to that level. And it is something that I'm expecting to see play out here over the next few months. I think we'll see buyers at the same level we saw earlier this week. I think we'll see that over the next few months as we head into historically the slow time of the NFT market. The second half of the year, we typically see a decline in buyers and of sellers, overall sales, and we actually see prices decline across collections as collectors in the US specifically look for opportunities to harvest losses for their taxes. Okay, so what has been moving the markets this week? Well, a lot of familiar faces. We saw the captains trade for over $5 million in secondary, with traders trying to assemble crews or teams. Ultimately, that will lead them to opportunities to buy the project's highly anticipated meme coin drop. Bored Apes and CryptoPunks also both having big weeks, and that's behind major individual NFT sales in those collections. Most noteworthy is a gold Bored Ape, number 1734, that sold for $1.2 million, and a zombie CryptoPunk, number 8531, that sold for just over $1 million. Now, that Bored Ape actually was sold at a loss. Last year, sold for $2.4 million. You can see they lost about half of the value in that NFT. Back to CryptoPunks, though, in total, we saw 27 CryptoPunks sell for over $100,000 in this past week here. It just highlights the appeal of that iconic collection, and it's the collection that inspired the PFP craze that we're seeing across blockchains here. From the look of these collectibles, their traits, all the way to the tech behind them. It's the ERC 721 token standard that most NFTs on Ethereum use to mint. All of those can be traced back to the king of NFTs, that's CryptoPunks. And finally, the NFT community came together this week, celebrating an interesting art and PFP hybrid collection called Opepen. That collection comes from an artist named Jack Butcher. This week, we saw Twitter influencers and Web3 companies like OpenSea and Rarible, Nifty Gateway, and Trust Wallet all changing their Twitter profile picture to one of these one-of-a-kind Opepen images. All of that extra attention drove the collection to the top of CryptoSlam's 24-hour rankings, and so far this week has traded for over $1.8 million. So like I said to start, lots going on in NFTs. Still, we are hitting 2-year lows in various metrics. But even if prices are low, spirits out there in the NFT community are high. It's like there's a Wolf of Wall Street meme where you see Leonardo DiCaprio saying, "I'm not leaving." That is absolutely NFT traders today. They're not going anywhere. Back to you.
As usual, Yehudah, great to see you, and thanks for those insights. All right, and it was great seeing you too, everyone. That's a wrap on this week's show. Thanks for tuning in. And hey, we truly appreciate it. If you're watching this online, please like and please subscribe to this video. Or if you're watching from home or at your office, stay tuned right here on this channel if you're doing that. I'm Forkast Editor-in-Chief and your host, Angie Lau. I truly appreciate all the time that you've spent with us and vice versa. Join us again this time next week as we bring you the latest from the world of Web3 and why it all matters. Forkast IQ. Get intelligent in Web3.